Zee Entertainment, India's largest homegrown entertainment brand, and a name that's in almost every living room in the country, is now trading at levels that we last saw in 2007. That's an 18-year rewind on the stock chart. But before that happened, there was this superb run-up, making them like a standout stock. Like they were like 51 rupees in like March 2009, and by Jan 2018, they were 550 rupees. That's a 1075% return. One of the best runs in the Indian media space. But since that peak, things went downhill, both literally and figuratively. Around May 26th, the stock has crashed nearly 82%, wiping out a decade of gains. So what went wrong here? Now, trouble really started brewing in the hood around 2018 when Zee got caught in a scandal that linked their promoter SL Group to a shell company. Then you had Zee's founder Subhash Chandra, who made some risky infra bets. Then the ILNFS collapse happened, and to top it off, there was an overpriced Videocon D2H deal that made things worse for Zee. But like Star Wars, there came new big hope. There was a merger with Sony Pictures Networks. But after that announcement came some legal troubles, some defaults, some delays, and soon the deal was off. Now, obviously, Zee's stock dropped further, but it did jump around 15% in August last year, that's in 2024, after both Zee and Sony reached a settlement. Well, now that you have this true life recap of Zee's past, the question we should be asking is this like a fresh start or a calm before the storm? You know, a pause before the trouble. Let's find out. Welcome to Bottomline by Groww. In today's episode, we're going to be breaking down Zee Entertainment's story, its rise, its fall, and what lies ahead. Now, back in the day, and this is really around the time when your parents were probably in college, Zee was the crown jewel in our country's media landscape. They had iconic channels. They had a seriously vast library of great films and music, and even an OTT platform, ZEE5. They were a household name, and the media empire was commanding nearly 17% market share. To put it very mildly, that's a huge number. But along with their stock's rise, they had a dream sequence worthy of being in one of their own serials. But things took a sharp turn in 2018. Now, the first shock came when Zee's promoter company, SL Group. Now, these are the same people behind the SL World amusement park. So, the SL Group was linked to a shell company called Nityank Infra Power and Multi Ventures. Okay, so this company, Nityank Infra Power and Multi Ventures, was being investigated by the Serious Fraud Investigation Office, that's the SFIO, for some suspect deposits during the demonetization period. Now, turns out that Nityank had backed around 1600 crore rupees of SL Group's loan through debentures. That set off alarm bells, raising major concerns that there could be some hidden liabilities within the group, and that triggered margin calls. Now, with Zee's shares pledged as collaterals for SL's debts, you had everyone, lenders, banks, NBFCs, mutual funds, dumping around 65 lakh or 6.5 million Zee shares in one trading session. Now, that sell-off was brutal, and public's confidence began to crack. And what has happened so far can be aptly put as picture abhi baki hai. This was just the tip of the iceberg. The real issue here was that there was a debt mountain that was quietly building up. Now, Zee's founder, Subhash Chandra, had made some aggressive infra bets, and all these projects were way outside Zee's core business. This is one. Then you add to that the ILNFS crisis, which froze liquidity in the market. And then you have a very overpriced acquisition of Videocon D2H. Now you add these up, you have the SL Group sitting on 4,000 to 5,000 crore rupees of losses. By this time, the damage was done. You had retail and institutional investors hitting the eject button and racing to the exit. And with, these pledged shares flooding the market and a cloud of corporate suspicion ahead, Zee's glorious period turned into a bloodbath. And since FY19, Zee's profit trajectory, it fell off a cliff. Now, you look at closely, right? You look at this, there's a gradual recovery, but this bottom line really hasn't reflected on the stock price. And since then, investors have also remained cautious due to the uncertainty on their recovery prospects. But in 2021, there was a ray of hope. So in September 2021, Zee's board approves a blockbuster $10 billion merger with Sony. That's Sony Pictures Networks India. And that would be creating India's largest media company. And after that, due diligence wraps up. There's a definite agreement that's signed by December, and things look like things are on track. But things get bumpy again for Zee. So next year, that's in early 2022, you had IndusInd Bank dragging Zee to the Mumbai NCLAT over an alleged 83 crore rupee default. A few months later, IDBI Bank follows, and they're seeking insolvency proceedings over 149 crore rupees. In about a year's time, by March 23, Zee settled it with IndusInd Bank, but that was not before SEBI stepped in and temporarily barred Puneet Goenka and Subhash Chandra from holding bold positions. Now, that ban was lifted later, but it cast a very long shadow on Zee's governance standards. Last year, beginning by Jan 2024, after months of delays and behind-the-scenes negotiations, the Sony-Zee merger was officially called off. And in August, both parties announced that there was a mutual settlement and they closed the chapter for good. And since then, Zee has been trying to regroup. In Q4 FY25, they reported a whopping 1,306% YOY jump in net profit. But that excitement fades when you look into the details. Now, revenue barely moved, that's just jumping 1% YOY. Advertising revenue, their biggest segment, dropped 25%, while their subscription revenue inched up just 4% in Q4 FY25. So where's this jump coming from? Other sales and services. Now that jumped to 26%, which was a result of film releases, syndication deals, and non-linear content monetization. But even that profit spike has a story. Now in Q4 FY24, Zee reported 114 crore rupees in profit before tax, but they ended up booking a tax expense of a little over 101 crore rupees. That's an effective tax rate of 89%, thanks to merger-related costs and restructuring charges, which are non-deductible for tax. But by Q4 FY25, that cleanup had also begun. Now, effective tax rate dropped to 28% as Zee eliminated many of those one-offs that they had used to carry forward losses, and they also avoided some big deferred tax reversals. So reported profits were stronger. But again, this wasn't from top-line growth. Now, market share is also telling you a similar story, flat to slightly down at 16.8%, and that's slipping 10 bips QOQ. Now, the management is insisting that things are stabilizing. Now, CEO Puneet Goenka recently said that cost optimization was done and their focus had now shifted to growth. And a big piece of that growth could come from their OTT platform, that is ZEE5. Now, Zee is trailing the big players when it comes to their OTT platform, and they are showing signs of nearing profitability, something that could lift revenue and margins eventually. But that road isn't easy, right? Now, Zee is facing serious competition. You have the Reliance Disney merger. There's JioCinema, Star India, Viacom 18 under one roof. And Zee's competitive landscape just also got way tougher. You have ad budgets, viewerships, and content rights all up for grabs. And here, Zee could find itself squeezed. And to counter that, Zee is saying that they're exploring their own set of value-accretive M&A opportunities. Now, Zee is saying that they're looking to scale operations and strengthen their market positions through smart acquisitions. What those are, there's very little clarity there. And one more sore spot, leadership and governance. Now, SEBI is currently investigating Zee's top management and particularly their CEO, Puneet Goenka, for alleged fund diversion and disclosure lapses. Now, unless you get these issues sorted out, governance will have a bearing on investor sentiment. Now, on their valuation space, Zee is trading at 16.2 times their earnings, and that's well below their 5-year median of 26.7x. Now, that might make it look like a bargain. But, investors really want execution and credibility just as much as they also want numbers, and this discount kind of reflects a far more deeper unresolved issue. Now, the market is not really rewarding Zee purely on the strength of their legacy or their content library. There's this trust deficit that's running deep, and it's years of promoter-related controversies, mergers that didn't fly, and regulator scrutiny that's still on. But Zee Entertainment commands a very sizable share of the Indian media landscape. They have a vast library, 2.65 lakh hours of entertainment. They have over 6,800 movies, over 18,000 songs, and over 300 originals in 22 languages. All that's there. But for now, that potential is under-leveraged. How are you reading Zee? Are you calling it a turnaround in progress or a story that's run out of second chances? Leave us a thought in the comments. And for more such insights, subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.